everyone. This is Josh Carr with The Real Angle, and today we're talking to Jonathan Feifer. JJ, how are you doing today?
I'm good. How are you?
Great, great. Thanks for joining. Thanks for joining.
Pleasure.
So I always like to start with the basics. You run Parkstone Management, and I always like to put out the web address in case anyone wants to look it up. That's parkstonemanagement.com. So let's start with the basics. What does Parkstone do?
Uh, Parkstone is an investment and development company that I founded around 2014. Um, uh, the business, I grew up in a very entrepreneurial household. Everybody in my family, started their own business with varying levels of success, some quite a bit. And I when I went into real estate, it was always my goal to start my own business. So I
Do
worked
your own
for
thing.
a few people growing up. Josh, you being one of them. When
Yep.
I graduated, master's in real estate finance at NYU, it was a crash course on finance, which we could get into at some point. Funny
Sure, sure,
stories.
sure.
Um, and when I started out, we initially wanted to buy deals in Manhattan. We found a phenomenal deal. We needed time to put it together. What we realized very quickly was that in order to participate in New York City, you had to be a big boy and play the big boy table, the big person table, as it were.
Sure.
We weren't there yet, and we ended up losing a great deal because our process was a little bit slow. So I looked around and I said, well, I live in New York City. I want to benefit from the story and the growth that is New York, but I need a bit of a different market dynamic. So we started looking around New York, in New Jersey and Brooklyn, and there was a little bit more patience. There was a little bit more time that was allowed. There were less mature markets, less active investors, and it's there that we found our niche and
Sure.
our success.
Sure. And, it's funny because, I mean, when you talk about, secondary markets of New York City, be it, you know, Brooklyn, I think is at this point primary, but when you think about like
Yep,
the Jersey cities of the world or the Hobokens, like these are still major metro areas. Like it's still like when
absolutely.
people talk, I mean, I think people sometimes forget like New York City on its own is something like 10% of the American economy. Like and I'm pretty sure on that number, it's a mammoth market. So yeah, secondary
Huge.
markets are still bigger than some European countries. So what kind of so is Parkstone just you? Do you have partners? What's your layout right now?
I'm 100% a Parkstone.
Okay,
My model is uh, I have three buckets of deals that I do. I have deals that I do on my own. Those will be probably smaller deals.
sure,
I have deals where I will raise sort of as a friends and family, and then I have larger deals that I do where I'll partner with, co-developer, and um, we will go out to more um, high net worth family office types, and we'll raise money from there and deploy it into different deals.
Semi-institutional, if you will. Now
Yeah, yeah, yeah.
you mentioned development, so let's talk about
Yep.
pipeline. Like, what do you are you looking now at value add type deals, ground up development? What's the sweet spot that you're looking at these days?
Yeah, I have over the last number of years, I've focused on uh, value add, and we're not core buyers of anything. And anything that I buy, look, the reality is most of the stuff that I buy is off market. I mean, my our secret sauce is really to go out to walk streets, to network with owners, and to source deals that way. And we've been
Sure.
doing that for 10 years successfully. Um, uh, Everything that we do, there's got to, it's all about basis. And I think in the market right now, what we're witnessing is the importance of making sure that your basis is good. There's only so much that we can control in terms of capital markets.
Hmm.
And whenever you make an investment, you need margin because A, especially with with development. There's a lot of risk that entails,
Sure.
and there's a lot that we don't control. So the last deal that I completed was a 100 unit ground up development project in Jersey City in the Journal Square market. I brought on a 50% partner. I found the deal, as I said, by walking around in the market, found a piece of land that I liked, found who the owner was, called him, made a deal, subject to entitlement, which is again something that is hard to do in
Takes time.
certain markets, but
Right.
in other markets you can. Um, when we got our entitlements, we broke ground right around the start of COVID. That was an interesting experience.
Yeah, you
We
talk
pushed
about
through.
the things you can't control. That would be an
Yeah,
example of
exactly,
something you can't
exactly.
control.
So we had locked in a lot of our hard costs on the deal. We did experience some inflation, um, and really built through the pandemic, and happy that we did, because ultimately we were one of the few people that really sort of hit the market well. Our absorption was great. The deal ended up being a great deal. When
Rents
we
kept
went
going
through,
up, right? Or I mean, rents kept going up
yeah, yeah,
through
well,
all
yeah,
the years.
exactly. I mean, rents ended up being, I think 30 to 40% higher than we had underwritten.
Right.
So whatever increase there was in costs was more than offset by the increase in rent.
What was it like building
Um,
during COVID? What kind of issues did you run into?
well, we had on this particular site, we had a lot of rock. The Palisades rock where we built is some of the hardest rock in the world. So, and we were adjacent to two schools. So whereas in some situations you could just dynamite the thing and move on, we had to chip it. So at the start of COVID, our view was, well, let's maybe chip a little bit slowly to see kind of how this all plays out.
Okay.
And
Okay.
we did that. It took a few more months than it could have,
Okay.
by design. And then we decided we were just going to move ahead with the project, uh, and um, you know, obviously we got hit with some lumber increases that were fairly significant.
Sure.
We built
Sure.
the building is a 4/2 podium structure, and so we had, four of the floors were wood.
4 stories of stick
Um,
over 2 stories concrete. Sure.
that's correct.
Yeah.
Yeah, and
Which is what everyone's
uh,
building now. I mean, that's sort of the standard building type, it seems, in every
yeah,
secondary
yeah,
market in
yeah.
America.
Well, depending on the market that you're in, it makes sense.
Sure, sure. No, it's your comment about it's always interesting talking to people who build in dense urban regulated markets. So your comment about chipping versus other markets where you just be like blow up the rock and move on with
Move
it.
on.
Like
Yeah,
that's it. It's
yeah.
yeah, no, it's I get it. I get it. It's the problem with neighbors.
But
So
I don't think I actually answered one of your questions, which is pipeline. So in
sure.
terms of pipeline, we have so in any market that I'm in right now. I mean, we have active projects in Brooklyn. We have active projects in Jersey City. We have projects in other markets. We have a large 400 unit project in Reno that we're doing with several partners. Um, Reno being actually a great market. Also, you know, stick construction, 2 and 3 story buildings. Um, uh, we're going through a bit of a slow approvals process there. Our land basis, again, to my earlier point of a basis, is very
Hmm.
low. We bought it. We have no debt on it.
Which
If
is
it takes a
great.
little bit longer, land is very cheap out there. It's really fine. It doesn't really impact the deal that much. Um, in Jersey City, I've got, pipeline about 1,000 units right now. Um, and some of those deals I'm working on are subject to entitlements, which I'm very fine with at the moment. Some of them I've bought and I own, and we're taking our time through the entitlement process. Uh, what I'm focused on, I think, as a developer, I'm sure you hear this all the time. You really have to be sort of an optimist, and ultimately, I am an optimist. I think that the next few years are going to be a story about oversupply in a lot of markets, in Jersey City included, and I think all of that supply needs to play out. I think the deals that are currently in development, by and large, are probably going to experience some difficulty um, in terms of their financing. And what I mean by that is, um, you really need to have, I think, deep pockets, especially in these times.
Yeah.
Uh, I think a lot new deals are going to be extremely hard to pencil out. So what will happen is a lot of these deals will get delivered, they'll get absorbed over time, and then you'll start to see rent start to, creep up again, and
Hmm.
there'll be a need for new product in the market. And I think for our longer term deals, we want to be ready to develop with entitled projects when we see that opportunity, or before that actually happens, so that we could be in the market when those things happen. Now,
When
no
there's
one gets
actually
time.
demand. Yeah,
Yeah,
I mean,
no one gets timing perfect, but I think when we start to feel like the market's a little bit more stable, we'll feel a little bit better about getting some of those projects started.
no,
I
it's
don't anticipate we'll get anything started within the next 12 months, though.
yeah, just because of everything going on. Yeah, I mean,
Yeah,
material costs, I mean, they've come down, but still supply chains are a mess and interest rates
yeah,
are still high and et cetera. No, it's interesting. I mean, you're definitely the fact that you have a pipeline is interesting because you're thinking about it more than just simply one deal or this deal. It's more sort of like, how do I phase this? How do I bring it on board? I do need to ask the obvious question, which is Reno, Nevada is not next door to New Jersey. So why Reno? And this is nothing against Reno for anyone listening, but why? Like, how'd you end up
well,
out there?
it's interesting. So I want to add one other element here. For the next couple of years, we're actually starting a new platform with several partners where we're going to focus much more on acquisitions. I think the ability to go
Okay.
out to the market and to buy at or below replacement cost in many markets is going to be a really significant opportunity for a number of reasons. So I don't think there's a reason necessarily to do development near term, because I think the opportunity will be elsewhere. That said, longer term development opportunity is still important.
Based on where you're
Now,
on the cycle. Sure, sure, sure.
yeah, with respect to your question, um, I think when I looked at where things were, uh, how geographically focused I am relative to risk in the Northeast. I looked at some partners, a partner in specific that I brought on for my Jersey City project. It's a partner, Fields Grade. It's a group that's led by phenomenal guys, great guys. Somebody named by the name of Greg Russo, who's a principal
Okay.
at Iron State, and two brothers, Robert and Caulfield, who run a construction company as well. It's been a great partnership. We're doing other deals together. I think collectively we looked at each other and we said, well, let's try and be a little bit more geographically diverse. We all have great networks
Sure.
in the industry, and we started to look in other markets. We deal in Denver,
Okay.
um, in Reno, and elsewhere. And I think the process, our sort of this next iteration of this business, which will be with those guys, um, will include a number of different areas. I think that when we were sort of wrapping this up, we went to other markets. We spent a lot of time in the Atlanta market, and it was really, in hindsight, the height of the market, because we went there and we said, hey, this is a great market. Let's try and find a co-developer on the ground and put a deal together. But none of the deals made sense. Everything was like, let's build to a five cap.
Yeah, no, it was madness. It was madness. Yeah.
And it's just, we're not, we've maintained a pretty good investment discipline, and really aren't encumbered with deals that are at sort of at a level where it's frankly problematic.
Hmm.
But
Hmm.
that's where the market was and is in a lot of these areas, which is why I think there are going to be quite a few opportunities there.
No, and that's why I was asking. I mean, because there's
Yeah,
Reno, and this is again nothing against Reno. It's just usually when I talk to people from the New York metro market and I say, where are you looking? If not New York, Florida always comes up.
yeah,
Or
sure,
they have some generic southeastern location. They're like, I'm looking in Nashville, I'm looking in Austin. There were certain cities that
yeah,
everybody was looking in. And of course, if you have everybody looking in the same market, pricing, so
Our
Um,
our focus is, as we expand this business to other markets, our focus is really having great partners, local partners in other markets. And to the extent that we feel very comfortable with a local partner, um, we will go into that market. And I think so for us, this business, the partner, is as important as the deal, maybe more important in certain respects. And so we felt we have somebody who's based in San Diego. We looked at some deals there, and he brought us into the deal in Reno. We like him, we like the market there as we got
and
to
that's
know
great.
it, and that was the genesis of it.
And at the end of the day, it's still just housing. I mean, there's definitely a lot
Yeah,
more like than there's not. I mean,
yeah,
it is in some ways our business is tricky, in the other ways it's there are only so many ways to build a building. So yeah, no, it's
yes,
interesting. It's interesting. So so financing structures. We talked a little bit about financing structures and about your different pools of equity, and that's great. Um, Jersey City obviously is relatively regulated. That market you're dealing with rent control issues, you're dealing with that sort of stuff. I imagine in Reno, that's not even on the table or conversation.
no.
Um, you know, I'm just throwing this out there because it seems like rent control is like a great 30-year pendulum where it seems like we alternate between left and right on good idea, bad idea. And I'm not asking if you think it's a good idea, bad idea. I'm saying rather, does that enter into your thinking, like when you're looking at a market like Reno? Like, is that
Yeah, yeah, I mean, very much. I mean, it's one of the reasons why I ended up focusing a lot on new development, because new development, to the extent that you may or may not have a component of uh, rent protected tenants in a building as a part of an approvals process. But I try to exclusively focus where, or at least the majority of the units are free market. I've owned rent stabilized buildings. It's a very, very different business. I find it's a very difficult business. It's very difficult to make money. Um, One of the projects that I'm working on. So in Brooklyn, I do much more boutique condo projects, and I think it ties in well with what you're saying.
mm-hmm,
Um, when the rent laws changed in New York in 2019,
mm-hmm,
it became very difficult to condo a building by design. They wanted to keep as many buildings in a stabilized pool as possible.
right?
The only way to do it was to get a vacant building, really, in effect, and um, at the same time, still to ensure that tenants were not removed there in a way that was
They
problematic,
were
and
not
that could,
harassed in some form or
yeah,
fashion.
and that could be an impediment to actually condoing the building.
Right.
So we have a project there. I have a great local partner in Brooklyn with whom I've been doing business for a long time, Stuart Van Leenen, and another one in Matt Landau. So the three of us are have been doing these sort of smaller boutique condo projects in Brooklyn, and it's been great. And to the extent that we could find product, um, we're delivering into a market where inventory is down by 75 to 90%, 75 to 90% of this type, not brand new big, construction buildings with huge amenity fees and that are very expensive condos.
No, they're just smaller condo buildings. Sure.
Smaller condo buildings, low amenity fees. So, but what you have is, let's say we'll have a building, and right next door you have a rent stabilized building. It was built at the same time. It is the exact same building, notwithstanding our improvements that we're making. And we bought one for, let's say, just to choose numbers, let's say 4 million or $5 million, and the building next door might only be worth $1 million because it has tenants in there that are there. They're permanent legacy
Right.
stabilized tenants, and it's a very different business, and it's very subject to regulation, and you have to make sure that you're you're up for that.
What yeah, I mean what I'm hearing from you is, and I think it's useful for some of the listeners, is it's not just about, rent growth, it's also just about headache. It's about paperwork. Like I
It's
think a
about
lot of
time allocation.
yeah, you only have so many hours in the day to manage a
Exactly.
situation, and if you're managing paperwork and moving it from one side of the desk to the other, like that's not creating value for anyone.
Yeah,
You know.
documenting improvements that you're making to ensure that you're compliant. It's fine. And if you have a machine that you could insert that building into, where you have a lot of people that are under you that could do that, it could
That just
actually
do
be
compliance. Sure.
great.
Right.
But if you don't, it's a lot.
Yeah, and I just yeah, and that's why I was asking. It's no, it's definitely not that way in a lot of other markets in the United States. So it's New York City's kind of an odd beast in that
Hmm.
way. So, what sort of deals are so you're focused a lot on resi, obviously. We
Yeah.
talked about that. Any other product types you find attractive at this time, or are you really sort of sticking to resi?
Look, I'm sticking to what I know. When I look around the room, retail had its big moment a few years ago where
Hmm.
where values came down. Now it's compounded by the challenges of capital markets. Office is having its moment right now. Um, Even multifamily, to the extent that there's a stabilization, that had its moment in New York City and some other markets. Um, Multifamily right now is having a moment, but only to the extent that it's a capital markets driven issue. I think fundamentals are still very strong. So something I know and will keep doing. Uh,
No,
as
and
far
as
as
you
far as other
should.
things, not really. It's been, either for sale or for rent product.
I mean, that gets back to your comment about investment discipline. It's
Yeah,
there's nothing more dangerous, I think, than someone who's just sort of chasing a yield, and then just
yeah.
it's dangerous. It's dangerous. So, I always like to ask people this one question, which is, for good or for bad, things never work out as expected. Um, you know, big surprises recently? Anything blow up in your face, or find gold bars in the basement? Could be one or the other.
Um, uh, well, um, I could say that we put a deal under contract in Brooklyn about a year ago,
Hmm.
and the seller made representations that there was no harassment. So my two
Okay.
partners and I decided, hey, let's take this year. It's very unusual to have a year to close on a deal in New York City.
Hmm.
Let's take this year, try to get our plans as close to approval ready as possible. We will have saved a year of hold and finance and all that stuff.
Right.
And we're taking a risk here, but they're making representations. Anyway, it turned out there was harassment in the building. So
Turning the heat off on people, pushing old ladies downstairs.
yeah,
Yeah.
yeah. Look, some of it was benign. I mean, it seemed like the guy died and some heat issues. So it's unclear if there was really, kind
Sure.
of
Sure. Sure.
a
Sure.
an attempt to really harass people.
Right.
But the burden is really on the owner, and the courts are much, and the system is really designed to protect tenants. So we went back to the owner and we said, hey, we'll still buy this, but it's got to be at a significantly reduced number, because the cure is that 25% of the building that has to become stabilized. We said, okay, that's fine. But not only do we need a 25% reduction in the price, we also need the building is basically gutted. We need to, we need to completely renovate those units. So we need a reduction of the renovation costs of
Sure.
those units.
To put the people back. Right. 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 Right.
Yeah, so after hemming and hawing and just not understanding, they had, I think it took months and months and months of back and forth. They ultimately realized that we were right, and we made a deal that was within 1% of what we had offered them after discovering this. So I think it'll, we're still in that process right now. This cure program is not something I've done before, so we're going into it right now. And we're gonna learn from this process. It does give us another 6 to 9 months before we have to close, which we're not averse to right now. Um, so that was, look, we thought there was a decent chance that we were just going to lose our money there. Not our deposit, we've got on the back, but whatever soft costs we had spent with architects and engineers would have been gone. And again, that's part of this business. I mean, you go into things, you make decisions. I would make that decision again. I think it was a good decision, and sometimes the decision doesn't work.
Right. Sometimes
Um,
the bet works. Sometimes it doesn't. Yeah. It's about
yeah,
managing risk.
it's not, I think part of this business is dusting off and recognizing, where you maybe went wrong. There's another deal that I'm actually closing on next week, where it was a part of an assemblage, uh, where I put something under contract, um, had a hard deposit on it, with the goal of trying to pick up this middle piece, um, that ultimately I couldn't pick up. And so I had to walk away from a deposit. And again, it's a part of the business. You have to sort of make decisions sometimes, and be okay with something not going right. And hopefully you're making a lot more good decisions than bad ones.
Fair enough. Fair enough. So I guess my last question, in the future, 3 to 5 years down the road, what kind of stuff do you want to be doing?
Um, I think we're going to continue building out our pipeline of developments. I think we're going to partner with, um, two or three more good sponsors in markets that we're not directly in day to day.
Hmm.
Um, I think we're going to really push on the acquisition side of this new platform to buy over the next few years, quite a few assets, that are up and running, and
Sure.
see them through this next sort of supply glut, and hopefully, in a few years, maybe rates come down. That's going to be. I think that'll be an interesting opportunity. So in 5 years, I think it'll be hopefully with a platform um, of acquisitions that we've made over the prior number of years,
Right.
and sort of consistently active development pipeline. So a continuation plus the addition of the acquisition arm.
Fair enough. Fair enough. No, it's interesting. I mean, I always like to ask people's their growth path. No, look, it's fun to talk to someone who's actually doing real development, and is also talking about things like pipelines and strategy and all this kind of good stuff. Look, this has been very constructive. It's always good to talk about the markets and where we're going. Thanks again for spending time today.
Well, I wait. I have one sort
Okay.
of anecdotal
I'll
anecdotal
go, go, go,
story
go.
that
Yeah,
I'm
sure.
happy that I like to share.
Yeah.
So when I graduated from masters at NYU,
NYU. Sure.
um, I my underwriting, my skills in sort of Excel were not great. And one of the things that we did, Josh, at your company was, a lot of developers are good at developing, not good at the numbers. So we would sort of come on and really, on a long-term basis, help them figure out their numbers, and
Yep.
you
Yep.
know
Yep. Yep.
interact with banks and things like that. And that was a phenomenal way for me to really internalize and understand the numbers. And it was a little bit of trial by fire, because we would go and present to a client, JJ, new employee at Car Real Estate, and you know, JJ, this is your assignment. You know, you got to be basically the finance guy for this $100 million development.
Figure it out. Figure it out.
Figure it out. Figure it out.
The
Sink or
good news
swim.
is they generally knew less than you, so it was okay.
Yeah, yeah,
It's
yeah,
okay.
yeah, yeah.
It was okay.
But with some guidance from you at the
Sure.
time, we got through it, and I think it ended up for the better. So, gotta
Thank
thank you
you.
for that.
Well, no, and I appreciate you saying that. I will say that, for whatever it's worth, the only thing I've ever done professionally, I've always enjoyed teaching, and so and consulting is part of that too.
Yep.
It's always fun to see where people end up. The one reason I wanted to talk to you is because it's also amusing where, like, you actually, you know what you're doing and you've become successful, which is great. I've also had other people I've worked with who have gone on to greatness who I don't understand how. To be very honest, I've had some students from Columbia where I'm like, really? Like you're doing $1 billion project? You're the one doing it, But again,
They
better to be
convinced somebody.
yeah, better to be lucky than smart,
Right,
I mean,
right,
and that
right,
gets
right,
back to
right.
your comment about betting. Like, there's certain bets I think you make in your career where even if the bet turns out poorly, you're like, well, it was still a good bet. I mean, I didn't win, but I mean, the logic was sound. It just,
Yeah.
I mean,
Yeah.
I recently sold a building where we were trying to sell it right before COVID, and it fell apart because of COVID. Because the guy walked away when COVID happened, and my business partner on that said, "Well, what could you have done differently?" And I'm like, "Well, we could have sold it. We could have gotten their money hard before COVID happened, but
Right.
you know,
Yeah.
they were in the due diligence period. They walked away, and then it took another year and a half to sell the building. Like, what do COVID happened, so."
Back to the point about basics. You gotta have margin. And I think that's the lesson I think that a lot of developers are learning right now.
Yeah.
And they'll unlearn that lesson and then learn it again.
And
I
there'll
mean,
be
that's the
another
cycle.
crop of people who make
Yeah.
foolish mistakes, and then
Yeah.
you keep going. Yeah, no, I know.
Exactly.
That's fun to talk about.
As the
Anyway,
world
well,
turns.
nonetheless, thank you for saying that, and again, thank you for joining me. And
Pleasure.
perfect.
Okay. Take care.